I got a call from an entrepreneur the other day that was having trouble determining the value of their company. Specifically, the problem is that this entrepreneur's company participated in a market space where there's not a lot of publicly traded companies and, quite honestly, just not a lot of history out there. So they were having problems finding enough information to perform some of the typical valuation analysis, such as price to earnings or price to sales. What I recommend in this case is that you lean more heavily on the discounted cash flows method. Ideally, you'd like to have as many methods as possible and come back to a value, but sometimes you just can't, and you have to lean more heavily on the others. What the discounted cash flow method does is it takes the cash flows that your company is expected to generate over a period of years, and by the way, this information should be contained in your business plan, discounts them back to the present, and you're usually looking at 5 years out, minimum of 3, sums them all up, and arrives at a value of your company. This method is mathematically a little more difficult than the price to earnings or price to sales ratio method. So if you're having problems or need some help, give us a call at the Capital Match Point. What we ultimately want to do is make sure that our entrepreneurs are as prepared as possible when the time for negotiation comes.